Okay, let's unpack this. When you think about global finance, you might picture, sleek, modern skyscrapers and these giant consolidated banks. But today, we're taking a deep dive into Germany. It's a country whose banking system is built on a foundation so distinct, it really challenges those conventional images.
It really does.
Our mission.
Yeah.
To cut through the dense details of its unique structure, its supervision, regulations, and deliver the essential nuggets of knowledge for you. So you understand not just what makes it different, but why it, profoundly impacts its financial stability and resilience.
And what's truly fascinating here, I think, is how Germany's history, its whole context, shaped a financial system that really stands apart. It offers, valuable insights into alternative models of stability and consumer protection.
Okay.
We'll explore that distinctive three-pillar structure, the intricate layers of supervision, both European and national, the nuances of how banks are actually run, corporate governance, how your money is protected, which is always key, and the very unique philosophy behind its regulatory framework. It's a blueprint worth understanding, really.
A truly unique blueprint indeed.
Yeah.
Germany's banking industry isn't just one type of institution, is it? It's famously built on these three distinct pillars.
Exactly.
A setup you really won't find replicated elsewhere, not on this scale.
Yeah.
It's a foundational characteristic, I suppose, that shapes everything that follows.
Precisely. And this three-pillar system, combined with that historical universal bank approach, where most banks offer pretty much the full range of services.
Right, universal banking.
Yeah, that's led to a retail banking market that is both highly fragmented and, intensely competitive. It's a key insight into the German financial landscape.
So let's break down these pillars for us. What are they exactly? How do they function?
Okay, first you have the private banks. These are your, let's say, traditional privately owned commercial banks, often with a smaller number of dominant shareholders. They offer a full suite of banking activities and operate both regionally within Germany and, internationally. Deutsche Bank AG is probably the most well-known example here.
That sounds, somewhat familiar, I guess, to what you might expect in many countries. What then makes the other two pillars so distinct?
Right. Well, the second pillar is the public sector banks. These are publicly owned.
Publicly owned?
Yes. Their ownership comes from municipalities, counties, or the federal states, the lender. And a crucial difference here is that while they do aim for profitability, they aren't strictly bound by profit maximization.
Oh. Yeah.
Because they also have public tasks, things like fostering regional development. They provide a full range of services with a strong focus on borrowing and lending and operate under what's called the regional principle. Meaning their activities are largely confined to their specific geographical area. Think of the Sparkassen, the local savings banks, and the Landesbanken, which often act as central banks for groups of Sparkassen.
So, publicly owned, a broader mandate beyond just profit, and this strong regional focus. That is a significant departure. And the third pillar completes this unique tripod.
Exactly. The third pillar is made up of the cooperative banks. These are distinct, again, in their ownership.
Oh.
They're owned by a large number of their members who are typically private individuals, customers of the bank itself, actually, each holding a limited number of shares.
Interesting.
Similar to the public sector banks, their core business is borrowing and lending, and they also stick to that regional principle. Examples here are the Volksbanken and Raiffeisenbanken. So you have these three really distinct ownership and operational models, making for a unique and diversified banking ecosystem.
It's a very interesting approach to financial services, decentralized, community-focused perhaps.
You could say that, yeah.
But Germany also has specialized players beyond these three core pillars, correct? It's not just those three.
That's right. Beyond these sort of universal banks, Germany hosts a variety of specialized institutions. For instance, development banks, like KfW, the Kreditanstalt for Wiederaufbau.
KfW, right.
They're often public sector entities with specific promotional tasks like funding technology, housing, or environmental protection initiatives.
Okay.
Then you have building and loan associations, Bausparkassen. They're legally restricted to providing housing finance through specialized savings contracts.
Specifically housing finance.
Exactly. And real estate banks, which focus on financing real estate and often refinance themselves by issuing a type of secured bond known as Pfandbrief.
Pfandbrief. Okay, heard of those.
Highly rated bonds, usually backed by real estate or public sector loans. And lastly, you've even got auto banks owned by car manufacturers to finance vehicle purchases.
Wow, that's quite a specialized ecosystem. So how do all these different players stack up, in terms of market share?
Well, looking at data from around 2021, the credit banks, that category includes the larger private banks and also foreign banks, they hold the largest share, around 41.7%.
Okay, the biggest chunk.
Yeah. Then the savings banks, the Sparkassen Group, follow at about 16.3%, and cooperative banks at 11.9%. The Landesbanken, those public sector regional banks, hold about 9.0%, with other specialized banks making up the rest.
That really shows just how distributed and fragmented the market truly is.
Absolutely.
So what does this all tell us about the German banking system as a whole? What are the maybe key characteristics that define it? And perhaps offer lessons or even warnings for other nations?
Several key characteristics really stand out. First, as we touched on, it is overwhelmingly a universal banking system. Most banks are involved in a full range of financial activities.
Right.
Second, it's profoundly a bank-based financial system. Unlike some markets, say the US or UK, where capital markets play a maybe more dominant role. In Germany, banks are truly at the center. They bear risks on their balance sheets, and bank loans remain the predominant form of funding for businesses.
And what about how customers interact with banks? I've heard of something called the house bank principle. Is that still a major thing?
The house bank principle. Historically, yes, it described a very close, almost singular relationship. German businesses, even individuals, primarily relied on one bank for almost everything.
One main bank.
Exactly. Now, it has certainly loosened up in recent years. Companies now often work with 2 or 3 banks, and of course, online banks have gained significant traction among retail customers.
Sure, the rise of online.
But the legacy of those deep, long-term bank customer relationships still influences the market, you know? And finally, and this is critical, Germany stands out as one of the most fragmented banking systems in Europe.
Fragmented.
It's often described as overbanked and overbranched. We're talking around 1,500 credit institutions and something like 24,100 branches back in 2020.
That's an astonishing number of institutions and branches.
It is. And this fragmentation, well, it fosters intense competition, but it also creates unique challenges, maybe for consolidation and achieving global scale for many of its players.
Yeah, I can imagine. So, given this incredibly diverse and fragmented domestic structure, how do international players fit in? How do they navigate or even challenge this established German banking order?
Well, foreign banks certainly have a significant presence and impact. By the end of 2020, there were, I think, 201 foreign banks operating in Germany, either as subsidiaries or branches.
Okay.
The landscape for them has evolved a bit. The European passport in the 1990s allowed EU banks to operate easily across borders, which led to more branches from other EU member states.
Right, the single market effect.
Exactly. And more recently, post-Brexit, we've actually seen a trend towards establishing EU-head subsidiaries in Germany.
Interesting.
Most of these foreign institutions don't really attempt universal banking in Germany. Instead, they tend to concentrate on specific core activities where they have an edge.
Makes sense.
Collectively, though, they hold about 14% of the German market by balance sheets. So while the domestic pillars are strong, international competition is definitely very real.
Okay, so we've painted this picture of an incredibly diverse, fragmented banking landscape. The natural question then becomes, how on earth do you manage and oversee such a complex system?
Yeah.
That's where Germany's intricate supervision comes in, right?
Yeah.
With layers, both European and national.
Absolutely. And the supervisory landscape underwent, well, profound changes, especially in response to the 2008 financial crisis. That led directly to the establishment of the banking union across Europe.
Right, the banking union. What are the main components of that European oversight that affect Germany?
Okay, the banking union is basically built on 3 key pillars. First, there's the single supervisory mechanism, the SSM.
SSM.
Since 2014, the European Central Bank, the ECB, has been the direct prudential supervisor for the Eurozone's largest banks. These are called the significant institutions.
The big players.
Exactly. This ensures a consistent application of a unified EU rulebook. For the smaller banks, the less significant institutions, the ECB relies on national supervisors, but it still sets the overarching principles.
And the ECB has real teeth.
Oh, yes. The ECB wields substantial authority, granting and withdrawing licenses, assessing acquisitions, verifying compliance, setting additional capital requirements. They can conduct on-site inspections, sometimes even without prior notice in exceptional cases, and impose significant measures like capital surcharges or even removing management.
Wow, okay, so the ECB is truly the ultimate authority for the major banks. What are the other pillars of the banking union?
The second pillar is the Single Resolution Mechanism, or SRM.
Resolution, okay,
Yeah.
for when things go wrong.
Precisely. This created an EU-level agency, the Single Resolution Board, specifically designed to manage failing banks in an orderly fashion. The aim is to minimize taxpayer costs and avoid wider financial instability. And it's backed by a substantial single resolution fund financed by the banks themselves.
Funded by the industry.
Yes. And the third pillar involves harmonized deposit guarantee schemes. Common EU rules for things like payout periods and pre-funding to further solidify depositor protection across the whole bloc.
Got it.
And beyond these main pillars, you also have the European supervisory agencies, the ESAs, like the EBA for banking, ESMA for securities markets, and EIOPA for insurance. They work on developing consistent technical standards and guidelines across the EU.
So that's the overarching European framework. How then does Germany's national supervision fit into this grand scheme? How do they work alongside these powerful European bodies?
Right. Well, Germany maintains its own robust national financial supervisory authorities. They operate in close coordination with that European framework. These are primarily the Federal Financial Supervisory Authority, BaFin,
BaFin.
and the Deutsche Bundesbank, Germany's central bank.
Let's start with BaFin. What are its core objectives? What powers does it have?
BaFin's primary objectives are really about ensuring the solvency, the proper functioning, stability, and integrity of Germany's entire financial system, plus protecting consumers and retail investors. Its main tasks range from defining supervisory policy and doing the daily oversight to fighting money laundering. And BaFin has wide-ranging powers. It can demand extensive information, it can dismiss unqualified directors, order special inspections, even those surprise visits, and implement measures to avert danger, from warnings and fines right up to license withdrawals or closing a bank down.
So a powerful guardian.
Definitely.
And the Deutsche Bundesbank, the central bank, how does it contribute to this supervisory picture?
Well, the Bundesbank is, of course, an integral part of the Eurosystem, deeply involved in the ECB's monetary policy decisions. Nationally, it acts as the government's fiscal agent and, crucially for this discussion, plays a significant operational role in banking supervision, particularly in the day-to-day oversight of financial institutions. Its regional offices are often the initial point of contact for banks on supervisory matters, making it quite hands-on.
So BaFin handles maybe the strategic oversight and policy, while the Bundesbank is more on the ground doing the operational work.
That's a good way to put it, yes. Their cooperation and ongoing supervision is clearly defined by the German Banking Act. The Bundesbank handles the vast majority of operational banking supervision, evaluating documents, audit reports, financial statements, performing those on-site inspections.
The groundwork.
Exactly. While BaFin manages the sovereign functions, things like issuing legal acts and general regulations, there's actually a supervision guideline that further clarifies their responsibilities and ensures a constant, essential flow of information between them. It's a dual-pronged approach. Comprehensive yet practical oversight.
Okay, that makes sense. Now, beyond this external supervision, how are these German banks actually managed internally? I understand there's a fundamental difference in how corporate boards can be structured, especially compared to, say, the US or UK model.
Indeed, yeah. This brings us to corporate governance, and specifically the contrast between the one-tier and two-tier board structures.
One-tier versus two-tier.
Right. In a one-tier system, which you see more in Anglo-American countries, you generally have a single board combining both management executives and non-executive supervisors.
Okay.
This can sometimes mean faster decision-making, maybe more direct contact. However, the German system predominantly uses a two-tier structure.
And what are the implications of that two-tier structure, which is so common in Germany?
Well, the two-tier structure fundamentally separates management from supervision. You have a distinct management board, the Vorstand, and a separate supervisory board, the Aufsichtsrat.
Vorstand and Aufsichtsrat.
This clear allocation of responsibilities is designed to promote higher objectivity and independence, particularly in crucial areas like evaluating management performance and setting their compensation.
Checks and balances.
Exactly. While major management board decisions often do require supervisory board approval, which can potentially slow down some processes, this separation acts as a robust check and balance. It fosters, perhaps, a more deliberative and oversight-focused corporate culture.
Can you walk us through that German two-tier model a bit more, specifically for a German stock corporation and AG?
Certainly. So at the top, you have the shareholders meeting. They make the big decisions on things like profit appropriation, amendments to the company's articles of association, and electing the auditors.
Okay.
Then the supervisory board, SB, the Aufsichtsrat, sits above the management. Its key roles are appointing and dismissing members of the management board, rigorously supervising their activities, establishing committees, and representing the company in any dealings with management board members. They have the right to inspect the books, the assets, and demand reports.
The overseers.
Precisely. Below that is the management board, MB, the Vorstand. They're responsible for the day-to-day running of the company, setting strategy, ensuring proper business organization, risk management, compliance, and representing the company externally.
And they can't be on both boards.
Absolutely not. A core principle is no double membership. A management board member cannot simultaneously serve on the supervisory board of the same company. This clear delineation of power and responsibility with strict reporting requirements between the boards is really a hallmark of German corporate governance.
So, management board runs the business day-to-day. Supervisory board keeps them accountable. What are their specific obligations to ensure stability and proper conduct within the bank?
Well, the management board is under strict legal obligation to ensure an adequate business organization. That includes robust risk management, effective internal controls, and solid compliance systems. They set the business and risk strategy, and crucially, they must maintain the financial soundness of the institution. And they have to keep the supervisory board informed on all important matters.
Constant communication.
Yes, and each MB member has a personal duty of care, acting as a prudent business person would. The supervisory board, in turn, has that critical role of appointing and removing MB members, determining their compensation, often a sensitive topic, and mandating the external auditor for the financial statements. They also have the power to call shareholder meetings when the company's interests demand it. The whole structure is really designed to promote long-term stability and responsible management.
It sounds like a very clear system of checks and balances. Now let's get to a question that's absolutely crucial for any bank customer listening. What happens if a German bank does get into trouble? How is your money protected?
Right, a vital question. This is where deposit guarantee schemes, DGS, become absolutely critical. Their purpose is really twofold. There's a social aspect, protect depositors' money, and then there's a financial system aspect, prevent destabilizing bank runs. If people lose confidence, they rush to withdraw funds, and that can topple even healthy banks.
The contagion effect.
Exactly, and Germany operates a pretty robust two-pillar system for deposit protection, which actually offers a higher level of security than you find in many other nations.
Okay, 2 pillars. Tell us about the first one, the sort of mandatory protection.
The first is the statutory DGS. This is mandated by law, the Deposit Protection Act, or Einlagensicherungsgesetz, EINSIG for short.
EINSIG, okay.
Membership is mandatory for banks taking deposits. It's managed by the BDB, the Federal Association of German Banks, acting as an authorized representative. This scheme provides that legal minimum protection of 100,000 per depositor, per bank.
The EU standard.
Yes, the harmonized EU level. It covers deposits in foreign currencies, too. And in specific limited situations, like if you've just sold a house, the protection can temporarily go up to 500,000 back.
Okay.
It's that baseline designed to give you, the depositor, peace of mind. But it's important to remember what's not protected.
Such as?
Financial institutions themselves, collective investment undertakings like mutual funds, insurers, government bodies, people holding bank bonds, their investments aren't covered. And, of course, assets that might have originated from money laundering are excluded. Right,
makes sense. So 100,000 is the legal minimum. What's the second pillar then? How does that offer even greater security?
Okay, the second pillar is the Einlagensicherungsfonds, ESF. This is an optional membership scheme, primarily for the private banks in Germany, and it's also run by the BDB.
Optional, but offers more.
Exactly. This fund provides complementary, much higher protection on top of the statutory 100,000 euro. It's risk-based, meaning the fund assesses its members. And while the maximum protection levels are actually decreasing over time, sort of aligning gradually with broader European trends, they remain very substantial.
How substantial?
Well, for example, back in 2023, it provided protection up to 5 million per retail customer and 50 million for corporate.
Wow, that's huge.
It is. The plan is to decrease those limits, though, down to 1 million for retail customers and 10 million for corporates by 2030. But even then, it's still an exceptional level of protection for customers of qualifying private banks.
That really is a strong commitment to depositor confidence. How are these schemes kept robust and accountable? How do we know they can actually deliver on these promises if needed?
That's a good point. Both the statutory DGS and the voluntary ESF conduct regular audits of their member banks. These are carried out by a dedicated organization, the Prüfungsverband EV, which is the audit association linked to the ESF.
Okay.
Now, this organization and the ESF itself has real skin in the game. Its financial viability and that of the protection fund is intrinsically linked to the health and resilience of its member banks.
So they have a vested interest.
Exactly. This creates a very strong incentive for extremely, let's say, thoughtful and proactive audits. They often go beyond just checking standard regulatory boxes. They aim to identify and mitigate risks long before they become systemic problems. It's a key aspect of preventing issues, not just reacting after the fact.
Proactive auditing, interesting. So with all these layers of structure, the pillars, the specialized banks, and this meticulous supervision, both European and German, you might imagine, a single hefty banking rulebook somewhere.
Yeah, I might think so, yeah.
But it's quite a paradox, isn't it? You mentioned earlier there's actually no single banking business rulebook in Germany or even Europe that brings everything together neatly in one place.
It's true, and it really speaks to the immense complexity. The rules are incredibly extensive, but they are fragmented. They flow from multiple sources. At the EU level, you have rulemakers like the European Commission, the Parliament, the Council. They issue directives and regulations.
The primary laws.
Right. Then you have EU authorities like the EBA, the ECB, ESMA, the SRB. They publish their own detailed guidelines and Q&A documents to clarify how those laws should be implemented in practice.
Okay, that's the EU level. And what about the German national level? How do they add to this regulatory tapestry?
Nationally, the German Ministry of Finances, the Bundestag, the Bundesrat, they issue specific German acts and ordinances or regulations. And then German authorities like BaFin and the Deutsche Bundesbank publish their own detailed regulations, circulars, and guidelines, interpreting those laws and EU rules for the German context.
So layers upon layers.
Absolutely. The sheer volume is staggering. I mean, the German Archive of Banking Laws, Regulations, Circulars, Guidelines, it includes something like 14,000 pages.
14,000 pages.
Yeah. Now, while basic banking services like taking deposits or granting loans have their core framework, areas like investment banking, investment services, asset management, they introduce an entirely different order of regulatory complexity.
That sounds like a full-time job, just keeping track, let alone interpreting it all. What's the guiding philosophy behind all this regulation in Germany? Is it sort of what is not forbidden is allowed, or is it the other way around?
This is actually a fascinating paradox, and it's really a cornerstone of German financial law. Generally speaking, German constitutional law tends to adhere to the principle of what is not explicitly forbidden is allowed. Freedom is the default.
That's okay, the default.
However, the German Banking Act, the Kreditgesetz, KWG, completely flips this for financial services.
How so?
It essentially prohibits any banking activity unless a specific license has been granted by BaFin. So, banks operate in a highly prescriptive environment. You need permission first.
Permission, not prohibition.
Exactly. This means that all those extensive rules must be meticulously interpreted within that legal framework to ensure compliance and, frankly, to prevent unintended loopholes. As a practical consequence in any case of doubt, well, a thorough legal analysis is always indispensable. You can't just assume something is okay.
Better safe than sorry, legally speaking.
Very much so.
Could you give us just a few examples of how these different regulations apply to common banking activities, just to make it concrete?
Absolutely. So for deposit taking, a bank mainly needs to navigate the Banking Act, KWG itself, the Deposit Protection Act, EInsig, we just discussed, and the Anti-Money Laundering Act, Geldwäschegesetz, GWG.
Okay.
For credit and loans, the European Capital Requirements Regulation, CRR, is absolutely key, setting capital standards. Alongside that, BaFin's very detailed minimum requirements for risk management, MRISC, is crucial for how loans are managed internally.
MRISC again.
Yes. For payment services, you're primarily looking at EU rules, like the Transfer of Funds Regulation and the Payment Services Directive, PSD2. And then for investment services, it gets really complex. You're dealing with a web of legislation, including the German Securities Trading Act, Wertpapier Handelsgesetz, and the big EU packages, MiFID II and MiFIR. These all interact.
A complex web indeed. You mentioned MRISC several times now, calling it the constitution of German banks earlier. Can you elaborate just a bit more on why it's so pivotal? especially for our informed listener, but maybe without getting totally lost in the weeds.
Right, MRISC. It's often called the Constitution because it really sets out the fundamental requirements for pretty much everything related to a bank's internal risk management processes: governance, internal controls, compliance functions, how risk interacts with business strategy. It covers it all.
Okay.
Now, it is principle-based, meaning it lays out broad objectives like manage your risks properly. But, and this is the crucial German aspect, it's interpreted in practice with an expectation of almost phrase-by-phrase implementation.
Phrase by phrase.
Yes. This creates a deeply granular culture of compliance. What this means in practice is what supervisors call the show-me approach.
Show me.
Banks aren't just expected to understand the principles in MRISC. They must meticulously document and be ready to demonstrate to auditors exactly how they comply with every single relevant phrase or requirement within MRISC.
That sounds incredibly detailed.
It is. And while this ensures a very high degree of diligence and oversight, which contributes to stability, it also creates a substantial bureaucratic burden. It can definitely impact a bank's agility and its capacity for rapid innovation, especially when you compare it to regulatory regimes elsewhere that might prioritize broader outcomes over such granular procedural conformity. It's a fundamental trade-off that really defines much of German banking supervision.
That's a really clear insight into the practical impact of that detailed approach. Okay, so finally, if European guidelines, say from the EBA or ESMA, are issued, how do they actually integrate into this already complex German system? Do they just slot in?
Not quite automatically. Those guidelines typically follow what's called a comply or explain procedure.
Comply or explain.
Yes. The supervisor, the ECB for the big banks, or BaFin for the less significant ones, will officially declare whether they intend to comply with those specific EU guidelines. Usually, BaFin integrates the substance of these guidelines into its existing German supervisory practice publications, like MRISC or Mokomp for compliance, or others.
So they get woven in.
Exactly. They get woven into the German framework. This means that while these European guidelines aren't always directly applicable as standalone rules in Germany, their content is almost always carefully incorporated, often shaped by specific German interpretations, wording, and existing practices. It ensures consistency, but within the established national approach.
Okay, well, we've certainly covered a lot of ground. We've navigated the unique three-pillar structure, explored the specialized banks, delved into the dual-layered European and national supervision, understood that two-tier board system, and unpacked the layers of depositor protection and that granular yet fragmented regulatory labyrinth. It's truly been a deep dive that showcases Germany's very distinct approach to finance.
It really has, and maybe this raises an important question for you listening. Given Germany's fragmented yet robust, clearly bank-based system, with its deeply embedded supervisory practices like MRISC and those strong depositor protections, what lessons or perhaps challenges do you think this model presents for other financial systems around the world, especially as global banking becomes even more interconnected and arguably needs to be more agile?
That's definitely something to mull over as you go about your day. Until next time, keep diving deep.